Have you ever wondered how investing works? It's a question that many people ask, and today we're going to unravel the mystery. Investing is the act of allocating resources, usually money, with the expectation of generating a profit or income. It's about making your money work for you, rather than you working for your money. Investing is vital because it allows your wealth to grow over time. Think of it as planting a seed today to harvest a tree full of fruits tomorrow. It's a powerful tool to achieve financial independence and secure a comfortable future. However, investing isn't a gamble or a get-rich-quick scheme. It requires patience, discipline, and a clear understanding of the risks involved. There are many myths about investing that can hinder your progress, but don't worry, we're here to debunk those myths and guide you on the right path. Now that we have laid the groundwork, let's dive into the steps to start investing. Before you start investing, you need to set your financial goals. This isn't just about dreaming of a yacht or a mansion. It's about setting clear, measurable, and achievable targets that align with your financial aspirations. Think of these as your financial milestones. They could be as simple as saving for a vacation, buying a new car, or as significant as planning for your retirement. But how do you categorize these goals? Here's a simple way to look at it. Short-term goals are ones you'd like to achieve within the next 1 to 2 years. Medium-term goals, on the other hand, are targets that can be reached within 3 to 5 years. And finally, long-term goals are those that take more than 5 years to accomplish, like saving for a house or planning for a comfortable retirement. Setting these goals is not a one-time exercise. It's a continuous process that needs periodic reviews and adjustments. Remember, your financial goals will guide your investment decisions. In the world of investing, risk and return go hand in hand. You might be wondering, what does this mean? Well, let's break it down. Risk refers to the potential loss that you could face when you invest. Return, on the other hand, is the profit you could gain from your investment. Now, here's where it gets interesting. Generally, if you want the chance to earn higher returns, you have to be willing to accept higher risk. This is because investments that have the potential for high returns are often more volatile, meaning their value can fluctuate greatly. But how much risk should you take on? That's where risk tolerance comes into play. It's a personal measure of how much uncertainty you can handle when it comes to your investments. Understanding your own risk tolerance is crucial. It can guide you in making decisions about where to put your money. Remember, higher potential returns usually come with higher risk. But don't fret. Understanding and managing risk is a part of the investment journey. Knowing your risk tolerance can help you make informed investment decisions. One important strategy in investing is diversification. Think of it as not putting all your eggs in one basket. It's the practice of spreading your investments around so that your exposure to any one type of asset is limited. This strategy can help reduce the risk of your overall investments. By owning a mix of assets, you're less likely to face financial disaster. If one investment performs poorly, you're in a better position because the other investments can help offset the loss. For instance, if you only invested in technology stocks and the tech sector crashes, your portfolio would take a significant hit. But if you spread your investments across different sectors such as healthcare, finance, and real estate, a slump in one sector may be balanced out by the performance of others. The key takeaway is this: diversification can help you avoid the devastating effects of putting too much faith in a single investment. Diversification can help you balance risk and return in your investment portfolio. With so many investment options out there, how do you choose the right one for you? Well, it's like shopping for shoes. You wouldn't buy a pair that doesn't fit, right? Similarly, when it comes to investing, you want to pick the option that fits your financial goals and risk tolerance. Let's talk about some of the common types of investments. First up, we have stocks. Stocks, or shares, represent ownership in a company. They can offer high returns but come with high risk. Think of them as the stilettos of the investment world. They might give you a great height or return, but there's also the chance of a painful fall. Next, we have bonds. Bonds are like your reliable pair of sneakers. They're loans that you give to a company or government. In return, they promise to pay you back with interest. The returns aren't as high as stocks, but they're generally safer. Then we have mutual funds. Think of them as a shoe rack filled with a variety of shoes. A mutual fund pools money from many investors to invest in a diversified portfolio of stocks, bonds, or other assets. They offer diversification, which can help spread out risk. Finally, there's real estate. Investing in properties can be a good way to generate rental income or profit from price appreciation. But like a pair of designer boots, they require a significant upfront investment. So how do you choose the right investment? It all comes down to your financial goals and risk tolerance. If you're saving for a long-term goal like retirement and can handle some ups and downs, stocks or mutual funds might be a good fit. If you're looking for steady income and prefer less risk, bonds could be your go-to. And if you have the means and passion for properties, real estate could be your perfect pair. Remember, there's no one-size-fits-all in investing. It's about finding the right fit for you. And just like with shoes, don't be afraid to try on a few before you find the perfect match. Choosing the right investment can be a game changer in your journey towards financial freedom. Do you know about the magic of compound interest? Picture this, you've invested $100 at a 10% annual interest rate. After a year, you've earned $10 in interest. But here's where it gets interesting. That interest also earns interest. So in the second year, you're not just earning interest on your initial $100, but also on the $10 of interest that you earned in the first year. That's compound interest in action. It's like a snowball rolling down a hill, gathering more and more snow as it goes. The longer it rolls, the bigger it gets. That's how your investment grows over time. The longer you keep your money invested, the more you'll benefit from the power of compound interest. It's a simple concept, but incredibly powerful. It can significantly increase your investment returns over time. So, remember, the earlier you start investing, the more time you give compound interest to work its magic. We've covered a lot today, so let's quickly recap. We kicked off our journey into investing by understanding its essence, a powerful tool to grow your wealth. We learned that setting clear financial goals is the foundation of any successful investment strategy. Then we ventured into the world of risk and return, unraveling how they are two sides of the same coin. We also discovered the wisdom of not putting all our eggs in one basket, highlighting the importance of diversification in an investment portfolio. Next, we delved into the process of choosing the right investments, emphasizing that one size does not fit all. Last but not least, we explored the magic of compound interest, the secret ingredient that can transform small, regular investments into a substantial sum over time. Investing may seem complex at first, but with knowledge and discipline, you can make your money work for you and achieve your financial goals.